Hello and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am Pushpendra Mehta, and my guests for today are Anthony Carfang, Managing Director of the Carfang Group, and Craig Jeffery, Managing Partner, Strategic Treasurer. Welcome to the Open Treasury podcast, Tony and Craig. Thank you for taking the time to be with us on this podcast. It means a lot to us. I, for one, can't wait to hear your thoughts.
It's great to be here on the podcast. I'm looking forward to a great conversation.
I am too. It's so good to both see you and hear you. I know we're looking over a Zoom meeting. Not that everybody else is going to see that, but it's good to talk to you, Tony.
So this week, we are focusing on 4 stories that cover 3 themes. We'll touch on the economy, digital currency, and crime-fighting technology. You can find these articles in the show notes from this podcast or by looking them up on CTMfile.com. The first story that merits discussion is about widening sanctions that have disrupted Russia's Eurobond servicing. Just to give you a little background, earlier last week, a US waiver that allowed Russia to service its Eurobonds in the original currency of issuance expired. In response, Russia's finance ministry announced that it was replacing Citibank, which has stopped servicing the Eurobonds, with Russia's National Settlement Depository, or NSD, as the country risks its first major external debt default in more than a century. Russian finance minister has said that Moscow would continue to service external debts in rubles, but foreign Eurobond holders will need to open ruble and hard currency accounts with Russian banks in order to receive payments. The NSD, unlike other major Russian financial institutions, is not currently subject to US sanctions. However, the European Union on Friday imposed sanctions on the NSD, which was meant to process the bond payments, further complicating matters for Russia. Tony, to you first. Do you think foreign investors are unlikely to acquiesce to Moscow's requests to open Russian accounts or do you think is the rope going to run out? Would there be a broader contagion effect if Russia is eventually declared in default?
Well, Push, I think you put your finger on it when you said that this is a very complex issue. Payment systems and financial flow systems had been globally interconnected, and with the push towards speed and instant payments, what we find is great interoperability among payment systems around the world. What these sanctions do is interrupt that and actually eliminate several nodes from the system. We don't know what the full implications of that are going to be. Clearly, Russia will have difficulty making payments on its bonds in currencies other than rubles. However, the flip side of that is that Russia is still able to accumulate rubles. So from the standpoint of Russian financial wealth, it is not being diminished as a result of these sanctions. It's simply the movement of that wealth is simply being altered for a period of time. And I think you have nothing to look at more obvious than the appreciation of the ruble relative to the dollar and the euro to see that, yes, payments cannot be made in other global currencies, but the markets don't seem to think that that's much of a problem, as evidenced by the appreciation of the ruble.
Craig, I'd love your thoughts as well.
Every node, as Tony mentioned, is becoming less available for trade, tightening the financial handcuffs. It just seems like we're 100 days into the war. The sanctions have continued to spread. Shutting down these different methods of making payments is a challenge. And they've got $2 billion in payments due before the end of the year in US dollars. So you have a heart, you got a lot of blood. How do you pump it in the body? Well, if your arteries are clogged and you keep shutting those off, the pressure is going to keep building. And so it'll be interesting to see what this does in terms of heart pains or heart attack.
Well, from heart pains to heart attacks, from Russia to the US economy. The second story of the day is about the beginning of the so-called quantitative tightening that commenced in the US on Wednesday as the Federal Reserve let bonds mature of its US $9 trillion balance sheet without replacement. The balance sheet reductions is aimed at contracting the liquidity of the economy as the central bank begins actively fighting inflation. Tony, I know this is a subject that is very dear to your heart. So I'd love to know, what do you think the Fed's quantitative tightening will do? Will it drain liquidity from the financial system and increase borrowing rates for long-dated assets to weaken inflation? Will it increase volatility or produce another headwind for stocks? Or are we going to see a lot more action?
Push, to the second part of your question first, we don't know precisely how the Fed is going to execute its tightening. As you mentioned, that there is a $9 trillion balance sheet that is going to be wound down at some speed. We don't know whether the Fed will be first selling its longer-term maturities versus short-term maturities. We don't know whether it's going to actually be selling securities or letting securities roll off as they mature. All that means uncertainty, and that means volatility. So there will be volatility in the market. There's a real interesting question. People talk about the $9 trillion Federal Reserve balance sheet. When you break that up in very round numbers, you have $6 trillion of Treasury securities that the Fed is holding and $3 trillion of mortgage-backed securities that the Fed is holding. There's a possibility that the Fed will let its Treasury securities run off, but continue to hold the mortgage-backed securities to prop the housing market. But if they do that, what that really means is that they're going to be selling their shorter-term securities rather than their longer-term securities. All of that has great implications for the yield curve and for flows throughout the capital markets. It is not at all clear what that's going to look like. So quantitative tightening has never been approached on this scale ever before.
Never been approached before on this scale. Those are some very good points. Craig, would love your thoughts.
Yeah, from a quantitative tightening standpoint, I think the last time the Fed started doing this, they backed off really quickly due to what was happening with the economy. I think, Tony, your points about we don't know how they're going to do it or what rate. I think they've shared some numbers of what they're trying to do per month. My question, not answer, but my question is, raising rates will drive more money to the U.S. For people to get that yield. That puts some downward pressure on that because there'll be more cash available. So that might provide an environment for that to be a little more gradual, but dumping that back to the market, that's going to push rates up as well. It's going to put a pressure in the opposite direction. So how that's balanced, I don't know. Tony, I was wondering if you knew the exact way that would be, but that's kind of like, how do you figure out a formula when there's the variables, but you don't know how much they're going to put in each one? It's like it's a big question to me if they're going to do this gracefully or if it's going to cause dramatic shifts and volatility.
Well, Craig, that's very interesting. And in fact, we know the variables. What we don't know are the interrelationships between some of the variables as they play out in a quantitative tightening scenario. So, for example, as the Fed reduces the size of its balance sheet, essentially it's draining liquidity from the system, which is a reduction in M2 money supply, which are primarily bank deposits and short-term securities. That will have the likely impact of driving interest rates upward. At the same time, when you drive interest rates upward, you're going to dampen economic activity and conceivably lower the velocity of money through the system. How you orchestrate this to a soft landing is the real challenge. GDP is simply money supply times the velocity of money. If you want a soft landing, you don't want GDP to decline. But if you're going to reduce the money supply and reduce the velocity, how do you stop GDP from declining? That's a question whose answer we have not heard from this Fed or this Treasury.
Yeah, the quote from U.S. Treasury Secretary Janet Yellen, she had admitted was wrong about the path inflation would take, about it not posing a long-term problem. And more recently, there have been unanticipated and large shocks to the economy that have boosted energy and food prices and supply bottlenecks that have affected our economy badly. That's very much an understatement. The shocks are huge. The blockade from the ports for Ukraine to pump out food. These are pretty big significant items, which I don't think we're seeing the full run on of these global geopolitical events.
Well, and Craig, it's actually even more serious than that. We have failed to learn from history, apparently, as I understand the current approaches. If we look back to the last major bout of inflation, interest rates had to get up to 20%. It had to get ahead of the rate of inflation before it slowed inflation. Currently, the real rate of interest, the nominal rate minus the rate of inflation, is minus 7%. Money has never been easier. As a matter of fact, there's only been one occasion since the end of the Second World War where money has been easier than it is today. And the irony is that they're talking about money being tight, and it's not. The whole thought process that you read in the Fed minutes seems to me to be absent what we have learned from history.
Both of you made some great points. Money has never been easier. So moving from one form of money to another form of currency. The third story of the day is about Japan passing the landmark stablecoin bill for investor protection. According to reports, the Japanese parliament passed a law last Friday clarifying the legal status of stablecoins, essentially defining them as digital money. Under the new law, stablecoins are required to be fixed in yen or other fiat currencies and will need to guarantee holders the right to redeem at face value. Additionally, stablecoins can only be issued by authorized banks, registered funds transfer agents, and trust companies. Tony, my question to you is, in your esteemed opinion, does this Japanese legislation mean that other countries will follow suit? And does it also mean that the confidence in crypto will be restored?
Well, I actually think that's both very good news and very bad news, what happened in Japan last week. The good news part of it is that it brings some structure and regulation, much needed regulation, to a market that in fact wants that structure. Traders in cryptocurrency need a place to hold their currency in between transactions of other cryptos. They need a stable place to store their value without having to swap in and out of the crypto universe and into the fiat currency universe. And a set of rules and regulations would provide that structure. At the same time, what the Japanese regulations do is require the stable coins to be issued only by major banks and securities dealers. I'm not sure all the intricacies there, but essentially they are socializing the problem and they're making it a problem of the Bank of Japan. So you're taking all the risk and all the uncertainties of the entire crypto metaverse, and you're putting it on the Japanese central bank, as opposed to letting it kind of float on its own to stand or fall on its own. Although we've had some failures in the stablecoin market, a few weeks ago, Tetra and Luna blew up. A year ago, Titanium blew up. So why not let that market take its own lumps and not bring those losses back into the banking system? That sounds like a prescription for disaster. And I think the market will right itself. The need for regulations is huge. In the US, there's been a lot of lip service. Gary Gensler at the SEC talks about the need to focus on this. And Janet Yellen talks about the need to focus on this. Well, they both talked about it a year ago after Titanium blew up. And now they're talking about it again after Tetra blows up. And frankly, there doesn't seem to be any real framework for dealing with it from a regulatory front. I think when you have a regulatory infrastructure in place and a system for adjudication of disputes, then you'll have the market really begin to take off.
So, Craig, does the Japanese legislation mean that the confidence in crypto will be restored?
I'm not sure on that either. The issue of, volatility and stability. People look at some of the digital currencies, some of the cryptocurrencies that have a massive volatility aspect of it, and people are willing to bear those risks in certain situations. And then when you look at stable coins, that bubble of stability was burst. And so now it's how does legislation or regulation or different schemas allow that to move back to a stable area? That's to stability. This is what they're trying to do. I'll be interested to see how this works out over time. But your sense of stability is still volatility. That's going to require quite a bit of confidence building.
Push, about a year ago, I wrote about stable coins as being, almost analogous to money market funds, basically a place where value can be stored and stable between other transactions. But unlike money market funds, the stable coins are not required to report their holdings. Money market funds report daily that their entire portfolios, the net asset value of every security in their portfolio every day. There's tremendous transparency, which makes for a very robust market. It's interesting, prime money market funds, with all the regulation on prime funds, have seen their assets fall over a decade. So from about $1.5 trillion down to 400 billion because of the regulations. Stable coins with no regulations have gone from 0 to 160 billion inside of 18 months. While the stable coins say, we're holding high quality liquid securities, but we're just not going to tell you what they are. That comes up short in my book.
The fourth story up for discussion today is about the US Treasury driving artificial intelligence or AI innovation to combat money laundering. According to a strategic document by the US Treasury Department released last week, the US Treasury will focus more heavily on technical solutions to the country's growing and constantly challenging or changing money laundering challenges. AI is playing an increasingly important role in informing policymakers of illicit threats and vulnerabilities. Besides improving anti-money laundering processes, do you think the AI adoption will mitigate risks and also transform financial regulation and compliance?
I think the application of artificial intelligence is extremely powerful. We've long advocated that banks data mine their own payment data and provide decision support solutions for their own customers. Payments data and deposit data is extremely rich. The individual transactions that take place in the economy, hundreds of millions per day, represent a vast amount of information that can be turned into value when mined properly. In terms of anti-money laundering, the applications seem to be pretty obvious there. You can look for patterns, look for relationships, look for leads and lag times, whatever, and pretty much pinpoint. It's no different than when my credit card company calls and says, Tony, there have been charges on your gasoline credit card in both New York and San Francisco on the same day. How did that happen? That's pretty trite, but it's an obvious application. Tools are now much, much more sophisticated than that. It does, though, lead into the issue of privacy. It's one thing when you're looking at the metadata of the payments, but when you're actually trying to identify specific actors in the money laundering business or in any other business, that data also exists inside the payment shell there. I think that there are going to be issues that need to be addressed in that.
Craig, what do you think?
I like the article that you've highlighted here. This idea of Treasury's war, many of the listeners will be familiar with, I believe it's Frank Zarate's book, Treasury's War, where payment rails, messaging channels across the globe was used to tighten down against different types of terrorism, even more than anti-money laundering. And I think we're moving to Treasury's digital war. If there's Treasury's war, the digital war is expanded more. And I'll just go back not too many years when the Central Bank of Bangladesh had that theft. $951 million of transfers or messages were created to send money out of the New York Fed. 101 million left those accounts. The rest was blocked by anti-money laundering algorithms and programs. So that was an example of multiple years ago where something triggered it. Well, obviously 101 million left. where this had occurred, their net loss was 81 million. So this was a use earlier, not as sophisticated as today. This idea of these increasing sophistication of criminals to use technology requires an increasing sophistication on the defender side to find those, stop those, and block those, alert people to them. There's, not only what comes through on the messaging, even as we look and see what some of the central banks have done in terms of making aware of what's going on through these distributed ledgers, right? You may be anonymous on there, but they can track the transactions. They keep tracking the transaction because these are public ledgers. You may not know who's doing it, but you can see what's traded with whom, who's trading with whom. And as that process goes on, there's requirements in the US to report your holdings. And as soon as they figure out who has transacted between a physical bank account or where they have regular cash and the system, now they know a party. And then they can see how these parties trade. And so the use of AI, machine learning, and this expansive use of capturing data means that this pure anonymity is closing in. There's less space to play for that, which I think is really part of the story there. It's AI innovation. It's making sure you're capturing data so that at some point you can figure out who's doing trades that are related to money laundering, terrorist activities, or even just regular old tax avoidance.
Finally, I'd like to ask both of you, what is your choice for the biggest or most important story of the past week and why? Tony, if you'd like to go first.
Every morning, I listen to an economic report, and for the last week, they've been saying gas prices were up 5 cents a gallon overnight. And I've heard that now 6 days in a row. That's a lot. And I think that simply is the canary in the coal mine, if you will, about inflation perhaps becoming, at least for the short term, out of control. 2 weeks ago, no one would have guessed gas prices would be up 5 cents a day for 6 days in a row. Now it's happening. I'm really looking forward to this week's inflation number, and particularly hearing our central bank's reaction when that number comes out. I think we're going to learn a lot. A, when that number comes out and how the central banks react. Then B, how they begin. And I believe it's this week. They're expected to begin their quantitative tightening. I want to see whether they're going to sell treasuries or mortgage backs. I think that is going to be a huge point to follow.
Wonderful. What about you, Craig?
I'm going to go with the quantitative tightening story. I mean, one, it's never been done at anywhere near this level of magnitude. When it's been done before, it's been a bit, I don't want to say disastrous, but not as planned. And that ties into the biggest issue right now, I think, which is inflation concerns, the possibility of a recession for 2 quarters in the US, as we're expecting in some different locations. So that, in terms of unwinding some number of trillions of the 9 trillion that they have, is dwarfs the other stories of the week, in my view.
That was an insightful and informative conversation. A big nod of gratitude to you for sharing your discerning opinion with us, Tony. And a big thanks even to our CTMfile audience for joining us on this edition of Open Treasury. Please subscribe and look in the show notes for the article links. Thank you.
This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.